Hey guys, welcome to Make Money Count. Today we're going to be talking about net interest margins, aka how the bank profits on you. When you walk into the bank, how are they making money? How are they making money?
Oh, I thought you were going to explain it.
I mean, I can.
Okay.
The bank profits. No, Marcus is going to tell us about it.
So I think first off, it's important for anyone that's negotiating anything with anyone to understand the counterparty's position.
Right.
And although the banks are not just worthy adversaries, but at times insurmountable opponents, we do have a lot of information that we can rely upon to help us when we're negotiating with a bank. And that information's all found in the bank's quarterly reports, annual reports. So first off, I want to start by getting everyone a little bit pissed off. Okay?
Let's do it. I'm excited.
This is something that every single quarter, this number increases. But on average, the Canadian banks, just the big six banks, profit on average over $1,500 for every man, woman, and child in Canada.
Per what term? Like 1 year or a quarter?
Every year.
Okay.
Every year. Well, so what, $375 a quarter. But so every single year, the banks make $1,500 worth of profit off of every single person in Canada. Like, just let that seep in for a minute there. It's on the back of massive revenue numbers.
Mm-hmm.
But it's like $60 billion in profit that's just getting ripped out of the Canadian economy. Now, that number gets broken down and it has many different components. But especially at a time like the current period, like maybe the last year, when there isn't a lot of capital markets activities, not a lot of companies buying companies, using leverage and having banks manage that process for them and paying a lot of fees. Because the capital markets are making less money, the banks rely upon the consumer to supplement that income,
Gouging us more.
and they do that in two main ways. Number one is something called net interest margins, NIMs, and we've got a little chart here. I'm going to pull it up, and it shows you the net interest margins for the big five banks. You can see CIBC's at 1.51, Bank of Montreal's at 1.64, Scotiabank's at 1.54, TD's at 1.67, RBC is at 1.61. These numbers are bragged about in the quarterly reports, right? The goal of the bank is to continue to try to increase that net interest margin. The net interest margin is just the difference between the amount that they're willing to pay for deposits. So what's the rate they're going to pay you on a GIC? 1%. Maybe it's 2%. Maybe it'll start off at 3%. But trust me, eventually it'll get whittled down to the amount that is the bare minimum required in order for you to keep your money there in a GIC. Simultaneously, it's a difference between the amount that they're paying for the deposits and the amount that they're charging for the debt. So on your mortgage, in the same way that they're going to engineer that GIC rate down, they're going to be working to engineer your mortgage rate up, your line of credit rate up. The negotiation never ends. It is constant. It is daily. It is an analysis of their book to see how they can possibly incrementally change to profit more off of every single consumer in order to increase the net interest margin. If the net interest margin goes up, people get raises, they get bonus, they get patted on the back, they get sent on trips. Congratulations, Justin, for your district. The branches have increased their net interest margins, and your branches are above the 1.6 1.67% threshold of the bank as a whole, and therefore you get to go to Costa Rica with your wife. As a consumer, we need to understand that. We need to understand that there's always room to negotiate. And this is like, I'm going to just arm you with this information and you can use it when you go and talk to your bank. If you don't get anywhere, give us a call and we can help you too. But
we can definitely help
this is all we do on a daily basis. We try to engineer the lowest possible mortgage rate, not just today, but forever for our customers. That involves ensuring that the penalty that you get charged to break a fixed rate mortgage is minimized. It involves ensuring that if you're in a variable rate mortgage, when you switch, if you decide to switch to a fixed rate mortgage, you're getting the lowest fixed rate on the marketplace. And you're putting a little bit of weight behind your application or your desire to renew or refinance a mortgage when you're going through a broker that does 200 transactions in a month and $1 billion worth of mortgages every year. You're going to have a little more attention paid. The pencil on the other side is going to be sharper. Mm-hmm. But the banks don't want you to deal with a mortgage broker. The banks want you to deal directly. They want you to feel comfortable at your bank branch. They want you to be sticky. They want you to have a lot of products with them. They want you to have your RSPs with them. They want you to have mutual funds with them, your savings account, your checking account. And the more products that you have with your bank, the higher they will go on the interest rate on your debt. That's a report from the Bank of Canada. We've spoken about that before. Mm-hmm. So net interest margins are one very critical way that the banks are making money, especially at a time like this. We will continue to see net interest margins increase in Canada. At times, they've been in excess of 2%. So this is lower than they probably even want them right now. So where are they making their money?
Fees.
They're making their money in fees. They are making a lot of money in fees. And those fees come when you decide to break a mortgage because you're renegotiating it. Those fees come for charging you to make transactions in your bank.
If you have a safety deposit box you've never once used in your entire life, like me.
Oh, I mean, yeah, like I don't think that's a huge revenue maker, but so out of the $60 billion in profits, if we had a look at, let's look at TD Bank for a second. Do you want to pull up that how banks make their money? Okay, look at the percentage of revenue that comes from retail operations. Like just absorb that for a moment there. So out of their total $21 billion in quarterly revenue, 30% came from revenue from Canadians. And it's the most profitable segment of their market. So the next time your bank tells you that you're richer than you think, or that the green sofa is the most comfortable place to sit, just understand that like what they're doing to you while you're richer than you think and you're in the green sofa, there's nothing sweet about it.
No, they're screwing you.
And it is time for Canadians to start standing up to their banks. They are not your friend. The people at the bank may be very friendly, but they are motivated to drive profits to the bank so that the bank's shareholders can make money. RBC, same thing. RBC, just have a look here. So like the quarterly report for the bank, again, right? Like the bank just wants to show their investors how well they're doing at sucking the blood out of Canadians and ensuring that as many people get screwed on their mortgage renewal or refinance as possible, as many people pay the maximum amount on their penalty for their mortgage. Like, it's amazing that we let this institution speak to the same people in two different ways.
Yeah.
The problem is that the results of the quarterly report and the minutia of what's on their financial statements aren't advertised the same way that they advertise that you're richer than you think or the green couch is comfortable. So like, if you look at this, RBC income from personal banking, 1.6 billion. Income from wealth management, $1 billion. Income from insurance, $211 billion. Like, the amount of money that is being made on the backs of Canadian consumers should infuriate everyone. And if you know what, listen, if you're a shareholder of the Canadian banks, obviously it's not going to infuriate you, but just understand that you can negotiate.
Mm-hmm.
All of these products are negotiable.
Yeah.
And in the end, your bank will not be mad at you, and they will not cut you off. They will respect you for standing up to them and getting a price that is fair. And that's why we created this company. And when you see numbers like this, they should make you sick. And they make me sick. Like, this is...
I mean, you didn't even have to pay a penalty on your mortgage, so...
Well, I'll tell you something. That's something that people should understand.
Yeah.
You don't necessarily have to pay a penalty on your mortgage.
Yeah.
How about we just end on that? If you're thinking about refinancing or renewing your mortgage right now and you're being told by your bank, you're not going anywhere because we have you by the short and curlies, and there is no way you're going to leave us without paying us a $50,000 penalty, the first thing I would say is that a great majority of those penalties are being incorrectly calculated.
Mm-hmm.
And the best way I can tell you to test that is pick up the phone yourself and call and ask them to provide you with the calculation of the penalty. They won't do it.
Mm-hmm.
They will not do it. You have to ask them for the equation, which we have. We can provide it to you. We put your numbers into that equation and send it to them and show them, hey, how come this doesn't match what you're giving me as a penalty number?
Yeah.
And only at that point will they say, oh, yeah, you're right.
Whoops.
Yeah.
Sorry.
But just understand your opponent. Started off with that net interest margins, went into fees, but in the end, it means you're going to end up making money on your mortgage. Thank you.